Welcome to our discussion on accounting, and we are going to discuss today the use of accounting equation to capture the business transaction. As we move along, we'll slowly capture varieties of business transaction, put that into accounting equation, then convert the accounting equation into financial statement. So we have 3-4 sets to discuss that. To do that, let us make an assumption that we have the business transactions, and the business transactions are given here, and slowly we'll keep on increasing this business transaction. So the first business transaction is started business with cash, so therefore the capital is equal to cash. So on that date you have 100,000 and 100,000 capital. You can ask a question, why capital is shown as a source? Is the business is under obligation to give back the money? So therefore there is a related accounting concept, and that accounting concept is called business entity concept. The business entity concept says the business and the business owner are two different entities, and the financial statement reflects the financial position of the business, not that of the owner. So let me take you to the financial statement. So at any point of time, the financial statement does not reflect the financial position of the owner but of the business. So let us go back to our equation. Then they took a loan of 200,000, so the cash goes up by 200,000, no change in the capital, and a new source comes into picture, that is the loan. So loan is 200,000. So loan and capital, as I mentioned, capital is a money contributed by the owner, money contributed by the owners, and in this case the shareholders. And the loan is a money contributed by the outsiders, money contributed by the outsiders. So both are sources. One is contributed by the owner, the other is contributed by the outsider. So therefore the business is having 300,000 as of now. What to do with that? So they wanted to buy goods, so therefore goods or stock, if you're comfortable with that. So 120,000 goods purchase. As a result, the cash will come down to the extent of 120,000. No change in the capital, no change in, so therefore goods purchase is an acquisition of stock, and in that consideration the company pays or reduces cash. Then they purchase furniture, so one more asset comes into picture, and that asset value is 35,000, and to that extent no change in the goods, but to that extent cash reduces by 35,000, no change in the capital, no change in the loan. So at any point of time you can see that the sources of the business is equal to the assets of the business, which we mentioned once in one of our previous session. At any point of time assets have to be supported by the corresponding sources. Now if you see this here, they're purchasing a laptop. They're purchasing laptop but not for cash. Okay, but they are purchasing a laptop on credit. They're purchasing a laptop on credit. But where is this money coming from? There is no reduction of cash, so cash will remain same. No change in the goods, no change in the furniture, no change in the capital, no change in this loan, but they purchase the credit from one Mr. X, so therefore this will appear as a source. So let me show you that. So increase in the asset here resulted in increase in a liability. Once again, increase in the asset here is resulted in increase in a liability. So one transaction is shown on the asset side not as a reduction of cash, a new asset, supported by a creation of a liability. Okay, so at any point of time, as I mentioned, the sources and assets will be equal. Now they're selling. You can ask a question, why should I record the transaction on credit? So there is a relevant accounting standard, accounting concept for that, which says accrual concept. The entire accounting, corporate accounting, is based on accrual concept. It says both the cash and the credit transactions have to be recorded. That means the transaction to be recorded at the time of the happening of the transaction or at the time of the event, independent of the cash. So it is a recognition concept. That means when should I recognize the transaction? Accrual concept is one of the fundamental concepts of accounting. That is why even if it's for cash you record it, even if it's for credit I record it. Now I'm selling only 60% of the goods. You have 120,000 goods. You have 60% of the goods are sold for cash 150,000. So my cash will go up by 150,000. Stock will reduce by 60%, so therefore stock will become 40% of that. No change in the furniture, no change in the laptop, no change in the capital, no change in the loan, no change in X, but a new item called profit will come into picture, and the profit is equal to the 150,000 minus 0.60 of the goods purchase. How much did you purchase the goods? The goods that you purchased was 120,000, so you made a profit of 78,000. So here also there is a relevant accounting concept. Let me first explain that. The relevant accounting concept is called matching concept. That matching concept is a concept required for determination of profit. It says the profit should be determined by comparing the income or sales with the corresponding expenses or the costs, and the corresponding means for the period or for the capacity. So profit for the month is equal to sales for the month minus the expenses for the month. Profit for the year is the sales for the year minus expenses for the year. So in this example we are making sales out of 60% of the goods, so therefore that's 150,000 compared with the corresponding 60% of the goods. So that is why, so matching principle, accrual principle are important principles of accounting along with the dual aspect concept. So at any point of time, if you see the sources of a business is a capital, which is money contributed by the owner, a loan, money contributed by the outsider, and the profit is the money generated by the business. Okay, so therefore these are the three sources. Of course, as of now profit is 78,000. You have to see that we have not shown interest, we have not shown any other expense. As we move slowly ahead, we'll also bring that into account, into the books of account. So therefore at any point of time, every business transaction that is undertaken by the business will affect the source or asset or source and asset. Where is this coming from? Once again, this is also supported by an accounting concept called dual aspect concept, which says every transaction will affect both debit and credit. But we are not discussing the concept of debit and credit. We are saying that every transaction will affect either sale, either source or asset, or both. As a result for us, we are going to use that every transaction, after every transaction, the sources will be equal to assets. So if you see here, after every transaction, the source is equal to asset. So whenever there is a change in the source, there has to be a corresponding change in asset or a corresponding change in the source in such a way that asset will be equal to the corresponding sources, and the corresponding sources will be capital or loan or profit. Capital is a money contributed by the owner, loan is a money contributed by the outsider, profit is a money generated by the outsider. But this process of converting the business transactions into the accounting equation is actually governed by the accounting concepts which we have seen, that is dual aspect concept, the matching concept, the accrual concept, and the business entity concept. So therefore the conversion of transactions into accounting equation is based on certain concepts. Okay, so you have to, it is not an arbitrary, so the concepts are the business entity concept, accrual concept, the matching concept, okay, and the dual aspect concept. And therefore accounting is also therefore called the science, not just the art. So the concepts will affect the corresponding transactions on the accounting equation. Thank you very much.